Hello and welcome everyone. This is Steve Recchia with ERS. On behalf of myself and today's presenters and ERS, I want to thank you all for attending today's webinar titled Compliance, Avoiding Risks While Still Collecting Your Debts. Today is the last of the webinar series for the year. That's the bad news. The good news is relative to the topic and the speakers, I think we've saved the best for last here today. So a couple housekeeping items. If you have any audio or visual video problems, please contact GoToWebinar support and they'll be able to assist you. Also, if you have questions, and we certainly do encourage your participation with your questions, there's a question box on the GoToWebinar to the right-hand side of the screen. Just type in your question there, and one of the facilitators will present the question either during or towards the end of the presentation. One final comment, the PowerPoint and supporting documents are available right now online, ersinc.com. So you can grab those right now if you don't have them in front of you. Also, tomorrow afternoon, we'll have the PowerPoint plus the recording available to all the attendees today. With that being said, I now turn it over to the most famous dynamic duo in the industry. That is Denny DeSantis and David Glazerman, the Bursar brothers.
Hey, thanks, Steve. Thanks for that great intro. This is Denny DeSantis. And my brother David Glazerman and I wish to extend a very warm welcome to all of you. David, I remember when I first started working at the University of Pittsburgh several years ago that we were only concerned about three different things: FERPA, Title IV, including Perkins loans, and Health and Human Services regs because we had health profession loans. Now, these days, it seems that the compliance list is just very, very long, and more now the consequences of non-compliance, for the most part, are very significant. Now, the institutions that I'm aware of are all very risk-averse, and no institution wants any negative press that could affect recruiting efforts. So, David, what do you think?
Well, Denny, compliance probably is the hottest topic in the industry today, and whether you're talking collections industry or even higher education, compliance has just jumped right to the head of the class, right even ahead of affordability in some respects. And I think compliance, as you say, is really broadened considerably. When we think of compliance, a lot of times we're thinking Title IV. In fact, NASFA, the National Association of Student Financial Aid Administrators, is just surveying its membership now to determine which schools have compliance officers in their financial aid offices. And they're only thinking of it in terms of Title IV. But when we get into collections, we get past FERPA, we have to be thinking these days of FDCPA, we have to be thinking of Fair Credit Reporting, and with the new Consumer Finance Protection Bureau, the CFPB, the latest acronym we all need to learn and love, compliance is really becoming even a more critical issue, whether you're at a college or university, or particularly in the world of third-party collectors. This week, in fact, the CFPB announced it's going to be doing even more oversight with student loan servicers. So the top 7 servicers are going to be falling under the CFP umbrella for compliance. And anything that affects servicers, affects collection agencies, ultimately is going to affect those of us working on the campuses today in higher education. So compliance, definitely a lot of risk out there, much more than what we might be used to having to deal with, and the world is changing literally by the day. So timing is really good. We're going to spend the next hour and a quarter to hour and a half talking about compliance on various levels. Scott Nicholson, the president of ERS, is going to start out talking a little bit about what some of the issues are for third-party collectors. followed up by Michael Strachan, Corporate Counsel for ERS, who's going to give us some real insight on some of the laws and what the CFPB is doing. And then lastly, Pat Woods, the Executive Director of Student Financial Services at Southern Methodist University, and I hope not icy Dallas today. I hope it's a little bit warmer. But Pat's going to give us some insight on some issues that she's dealing with on her campus in terms of trying to get students to understand the rights and responsibilities. So I want to just, again, welcome everybody. Good afternoon, everywhere except out on the West Coast. For those of you on the West Coast, good morning. And I'd like to just turn the program over to Scott right now to talk a little bit about the issues facing ERS and other third-party collectors.
Thank you, David. I greatly appreciate it. I'm going to take an approach where I really just want to set the stage for the dialogue that really is going to emerge from Michael Strachan and Pat Woods, and then come back to me at the very end to just use it as a case study of what the impact of this climate has meant to an organization such as ERS from a staffing perspective and our investment in human capital overall. You know, throughout time, most agencies such as ERS and our peers in the industry have maintained a compliance culture. We have had FDCPA oversight, you know, the Title IV attestation audits, and other control-based audits. But it's the emergence of the oversight authority that's been bestowed on the CFPB through the Dodd-Frank Act. It put an increased emphasis on the policies and practices that impact how we work. You know, and further, as David just stated, there's a significant intersection that exists between the agency as a vendor and the school, the servicer, as a client, and how their independent practices and policies may have an impact on the other. And just, you know, some simple examples, institutional policies regarding practices such as credit bureau reporting, the accrual of interest and collection costs on debt, settlement guidelines, itemization or the documentation of the underlying debt, all impact in how an agency implements its collection practices, and we have to implement those under the litmus of the CFPB and governing bodies. And this has really forced agencies and servicers to step back and assess those policies as we enter contractual relationships. So the purpose of this webinar is to really touch on the new and emerging areas of compliance that impact the higher education community. I previously stated ERS as a company has evolved our practices and ultimately our organizational structure to meet these demands, and I will briefly touch on those and the evolution at the end of this webinar. But first, I want to turn it over to Michael Strachan, who is the General Counsel for ERS and our holding company parent, URS Holdings. You know, and as General Counsel, Mike has had the distinct pleasure of stewarding the compliance initiatives of our organization, dealing with the CFPB and their initiatives, and, you know, even sometimes telling me no, which can be a big task sometimes too. So Mike, without further ado, I'm going to turn it over to you.
Great, thanks, Scott. I'd like to say hello to everybody, and I guess share that I don't like to tell Scott no too often. First of all, it's not all that often that he invites a lawyer to come talk to a lot of people, so I'm going to take advantage of it. And if we're doing a good job in the legal department, it really isn't about saying no, but more about thinking about maybe you can't do that, how can we get you where you want to go? And I think that's kind of what we want to talk about today when we think about the CFPB and the impact it's having or going to have in the private lending sector. And I think we're all familiar with the cliche that, you know, hi, I'm with the government and I'm here to help. And everybody chuckles because we don't believe it. And what I'd like to point out that when we think about that statement, that really it's about our expectation. And if maybe from the start or on the front end of what the government is looking for lenders to be doing, if we can align what we do with that expectation, then maybe it's not such a shock down the road. And I think to start with, you know, the CFPB, when first was created, and I'm going to tell a quick story about Chief Operating Officer on the URS side that I had the pleasure of working with and was a mentor to me. And in some instances, I would talk to him and say, well, we've got an issue here, and this is really going to be a pain in the bottom. and what do you think? And his answer would be, not a pain in my bottom, which I think was his way of saying, well, we're going to deal with it, but you're just going to have to fix it and make it work. And I think from a student loan standpoint, when the CFPB was created, we didn't really see the impact coming as much. I know the banks were very concerned, and I can tell you from a collection agency standpoint, we all got very nervous because we saw a regulator coming into our space, but I don't know that the student loan sector really appreciated what was coming or what might be coming down the road. And now that the CFPB has very clearly put their hands into private student lending, the cost of noncompliance is going to go up. And again, I'd like not to talk in terms of the big bad wolf government that's out to stymie business or come after colleges and universities and lenders and servicers, because I don't know that that's the right expectation. Certainly one aspect is that noncompliance is going to get scrutiny by regulators. It can generate penalties and fines and public notice of violations, and in some instances suits. But I think more importantly, if we think about, from a college and university standpoint, right, from a business standpoint, your borrowers are your customers. And if we think about our customer experience, what we're hearing a lot of is feedback that we may or may not have been directly collecting and gathering, but the government is. And if we care about our borrowers as customers, and we care about damage to our brand that I know is very important in the sector, and then I think we care about the impact it can have on our revenue and on our growth strategies. And while I think we're facing a very tough regulator, one of the toughest because they don't have oversight, and they have regulations that give them very broad, sweeping ability to interpret law and even look at, from the standpoint of where there's no law, just decide that something's not fair. And that's that concept of UDAP. If there's an unfair practice, they can say you're not supposed to do it. But conversely, what our experience has told us is sometimes that our toughest clients or regulators, they wind up being a catalyst for some of the most positive organizational change that we can have. The long-term impact of a tough client or a tough regulator is you think outside the box, you push the envelope, you create new initiatives to do things that help you as a company in our case or as an institution in yours to be better. And I'm sure everybody on the call here thinks very highly of collection agencies and always have, right? We've enjoyed a reputation for a long time now as fine, upstanding citizens. And of course, I'm talking tongue-in-cheek because I'm a lawyer at a collection agency, which is probably two strikes against me. But I think the long-term impact of supervision in our industry as collectors is positive. Now, the evolution and the growing pains, well, they're going to be a challenge for us, as it's always about resources and allocating resources and cost. But the long-term benefits to us as an industry, I think our reputation will be better, and I think we'll be better able to serve our clients. And really, when you look at complaints that borrowers have and the concerns that your regulator in the CFPB now has about student lending, I think it's an indication of borrower dissatisfaction. And to some extent, you can look at that as sour grapes because these are people who owe money and they're not going to pay it, or maybe they are. But I think we're missing an opportunity and losing sight of the fact that they really are customers, and they're unique customers, right? I mean, I may be a customer of Target today and Walmart tomorrow and Kmart the day after if I can find one, but, the college that I graduate from, well, that's with me for the rest of my life, and I may have a couple of those under my belt, but most people are going to have one or two. So these folks go out in the world, and I don't want to say they represent you, but they are, right? I mean, they take that honor and that distinction or that dissatisfaction with them for a long time. Okay, so I'll hop off the soapbox for a minute and break down to a little bit of what does it mean that the CFPB is coming to town. Well, they have regulation and rulemaking authority, and that means they can put out some rules that we have to follow in any industry that they regulate, and that includes student lending, supervision and ongoing examinations, and that's certain industries and entities are going to meet their standards or level and be subject to ongoing audits. And finally, enforcement, and that's where they, based on complaints or issues they hear about, they have the ability to come visit and enforce the consumer protection laws. I'll take a brief minute here on this next slide to talk about, their core functions are to talk about financial education. And if you've taken a moment to visit their website, and I would encourage you to do it, they spend a great deal of time and effort understanding the student loan industry, and they've got a great deal of resources dedicated to it, and you can, and to the consumer education portion of it, and you can look at on their website. They've got, know before you owe. They've got repayment options and different things that students can use to understand their rights, and in the spirit of disclosure, get information. The CFPB is also going to monitor the financial markets for new risks to consumers, and that's a general statement. For you, what that means is they're going to monitor the student loan landscape to look for risk to consumers and new, if you want to call it, products or loans or the way that they're being handled. And that's going to include requests for information from market participants, which is you. And I think there is at least a dozen or so universities that voluntarily shared some information. Some of you may be on the phone. And that's how the government is learning more and more about the industry. Their responsibility, of course, is to restrict unfair or deceptive acts and practices. They'll do that through rulemaking, supervision, and enforcement. And the short version of that is, these are the rules we need to play by, and we've got to learn them, we've got to live by them, and we don't have to love them. I suppose we can, but that's a lot. Most importantly, what should you be doing? And I think, in thinking of the CFPB and what they're looking for, ultimately you need to be identifying and managing risk of harm to your borrowers. I think it would be wise to understand the CFPB examination modules. One of the things that Steve mentioned that was on the website, ERS's site, and put up the student loan examination manual that the CFPB put out, and this is essentially a roadmap to the things that they care about. And it talks in terms of, when you think of loans, advertising, marketing, application qualification, loan origination process, loan repayment, payoff process and payment plans, customer inquiries and complaints, collections, default, credit reporting, and of course what's been popular for some time, information sharing, privacy issues. So it's sort of a roadmap of the things that the government cares about. And when you think about expectations, I think you know what to expect. These are the things that they care about. They put them in a book, and they've suggested that these are the things that we care about and are going to look for. The other important piece is creating and implementing a compliance management system. This seems to be a big focus of the CFPB in getting any of the industries they regulate to move toward compliance management systems in an effort to manage the risk and avoid creating issues for consumers, in your instance, borrowers. And I'm going to talk about that a little more on the next slide. And I don't have enough time to go through a lot of this in detail, but again, there's some information that we put on the website that include the loan exam procedures. And the last bullet point here is the CFPB puts out bulletins and reports. One of them was a banking on campus forum, and that's on the website too. And that talks about, as a university, do you have debit cards? Do you have a relationship with a lender that's unique or exclusive on your campus? So those sorts of things that the government cares about. Okay, so the next slide here has a whole lot of stuff that deals with the compliance management system, and rather than just read it to you, I'll talk about it generally. If you have one or you're working one, that's great. My question for you would be, is it current? Is it dusty? Does it need to be refreshed? If you don't have one, I don't think there's a need to panic. What we found, and I can only relate our experience, was a couple of years back when the CFPB came out and ultimately started looking for compliance management systems, we had to learn what that meant, or learn what they were looking for. And ultimately, it's a comprehensive, formal system for managing compliance risk. And what we found was that we had a great many policies and procedures in place already. We just didn't have them put together in one formal system. They were typically, the right people were typically involved in reaching the right decisions, but without the formalities of a formal system and a cohesive management system, there was a greater risk that things would fall through the cracks, or things would get done on an ad hoc basis, and the right people weren't involved, or maybe not the right result. And when you look at the issues, there's a great many laws I think that you'd all be familiar with that you have to comply with, whether it's equal credit, truth in lending, fair credit reporting, a lot of these types of issues. And I'm not going to go into detail on those. But ultimately, a compliance management system is you have to identify the risk, the compliance responsibilities. You've got to, at a very high level, identify these risks and how you're going to deal with them. And you've got to communicate that across your institution. And I know this stuff is a little bit dry, so maybe the short version is you've got to identify the risk. You've got to have policies to talk about, hey, here's the risks, and here's how we're going to comply and satisfy those risks. And that's a very high-level type document, is a policy. And then you're going to have lots and lots of procedures that talk about, here's how we're going to satisfy those policies. Here's how we're going to achieve those. And the next step of that, I think we're ahead of the game on the slide. You probably got to go back. I'm not going fast enough for who's ever in charge of the slide. I think I'm on slide 8. You got to go back a little further. There we go. The other piece of the compliance management system, if you look past policies, procedures, really you get into audit, right? Because we have a bunch of controls in place to do things and make sure the right thing happens. And then beyond that, and those are the checks. And then after that, you sort of need to check the checker. And the example that comes to mind that I share from a collection standpoint is, so Scott's got collectors that get on the phone and talk to borrowers and try to work out and help them get their accounts paid. And to meet the responsibility of managing compliance risk, there's folks that will listen to phone calls or listen to recordings. And that's a procedure and that's a control in place to make sure that the right thing is happening on the phone. And that's a check. The next step is the level after that is to check the checker. And if you want to listen, if your control says listen to 4 or 5 calls a month for each agent, well then your checker comes in on a monthly or a quarterly basis and randomly audits it. So there's a bunch of audit process that should be going on. Some of the bigger challenges here, I think, are the resources that you have to dedicate to identifying the risks, really creating procedures, that meaningfully incorporate the processes that you have to get your result, but also at the same time address your compliance responsibility. Change management is a bit of a headache. I think every organization wrestles with that. From our standpoint as a collection agency, the example I would share is if we want to change a training manual, well, that's pretty important because lots of collectors will see that and then they'll get on the phone and they'll do something based on that. Well, who should have the authority to authorize that change? And should operations be involved since it impacts them? Sure. Should legal be involved because there may be the type of information that collectors are going to say on the phone? That's sure. Should QA be involved because they're the ones that are going to have to monitor for it to make sure it happens? Sure. So, think in terms of a training committee. And change management is one of those things that really cuts across all disciplines, and it can be something like, hey, are we going to change a notice or a disclosure in a letter to a borrower? And I think most of you are probably thinking, well, that's going to come from legal. Those guys and gals, they draft letters, but is that always the case? Are there letters that maybe aren't going through legal for one reason because they're not formal loan process letters or related to the loan or collection process? They're just they're sort of not related to that process, so that other people are responsible in sending them out? Should somebody else look at them? And I don't know. I'm just giving an example that there's a lot of things that you assess risk and say, how important is this? How big of a deal is it? And then decide who are the right people that should really authorize changes to it. And when you think about things that are student-facing or borrower-facing, I think most things there probably qualify. It's worth thinking about the right people.
Michael, I just want to take this opportunity to tell everybody again, if you have any questions, if you can type those into the question box, we'll be picking some of those up in a few minutes. But just one question we did have, in terms of campus collections, you can talk about changing letters or making process changes. University attorney should be involved. Who else would you see involved in the process for a campus collector, just to make sure that there is compliance in the collection office?
So in terms of changing a collection letter to a borrower, is that the question?
A collection letter or a business process even.
Well, and that's a loaded question, right? Because I think it would depend on the business process. The letter is certainly a good example because that's certainly borrower-facing, right? That's something that's going to wind up in the hands of the borrower, and typically lots of borrowers, because from an efficiency standpoint, we all like form letters that we plug in a name and an address. And I think letters need to go through some legal review. I think a business person who understands what's the point, what are we trying to tell the borrower, what are we asking them to do, right? So that whatever it is you're trying to achieve in the letter, that's not the lawyer's job to figure out. The lawyer's job the business person says, here's what we want to say and how we're saying it. The lawyer should look at, hey, is it legal to say it and how you're saying it and when we send it? And in terms of if anyone else is going to be involved on the back end to monitor the success or failure of the initiative, you may want them involved on the front end for some input as well. And that's one example. In terms of a process, and there's people that are experts at this and write books on it, and quite honestly, change management is something I think even those experts struggle with because it's always a challenge to talk about what sort of things need to get on the change management highway, right? That toll booth is the big challenge. But that's part of the risk assessment. I mean, if the process that we're talking about can have an impact on consumers, if we're talking about, so for instance, and I'll jump ahead here because I know my time is going to be limited, the forum that the CFPB had about, banking on campus. So if we're thinking about, as a university, hey, do we want to have some ATMs on campus? And do we want to have like a branch office for a bank on campus? Maybe it sounds like a great idea, but we need to think big picture and think, well, how's that going to work? They're going to give us rent and they're going to give us X dollars because they're going to be the exclusive bank on campus. So if that's something new that we want to consider, well, we have to think about the risk of that. And I think that's an important takeaway that the CFPB is looking for, is sort of a cultural change in the way that folks think, because if you're just thinking, hey, look, we'll get Bank X to give us X thousands of dollars every year, and then they'll sort of be the exclusive bank on campus, if that's all we're thinking about, we may be missing a risk to our students, because is that bank going to charge higher fees and rates and have fewer benefits than maybe what the normal market bears, and your students are going to sort of get a worse deal than they could have if they went elsewhere, and they're going to do it because they're not captive, but it's convenient to them. That's the sort of thing the CFPB is looking at, and it may be that it can be win-win for everybody that says, hey, this can be a win for the university, there can be some revenue here and convenience to our students, and it can be a win for that bank because they're going to have sort of a sole access or access without competition on campus to our students. But it needs to be a win to the students too, right? If there's 10,000 students or 50,000 students, is that leverage to drive a better deal than prevailing market? And I know that really wasn't necessarily your question in a process, but you have to look at any business process, whether it's a new initiative or whether it's, hey, can we offer this way to restructure loans for consumers, or these types of payment plans. We haven't done these in the past. I think there should be change management to make sure that the right people, whether that's business, legal, quality, whoever it needs to be, to talk about what sort of things should we be thinking about, because there's, it's not just about the university, it's about the consumer, and again, in the instance here, it's the borrowers. Is that making sense? Does that help at all?
That's good, Michael. We do have one other question that's related, I think, to some risk aversion. Can you give examples of when the combination of fees and late charges might become usury?
Well, I think that's really going to be a state law question. That's something that state laws typically address those types of issues. And as I sit here, I'll be honest. Sometimes you have to admit I don't know the answer to that off the top of my head in terms of, hey, generally it would be this percentage or not. But that's certainly an issue, right? If you want to talk about a process or an issue that we want to change fees or we want to look at fees, that's certainly an issue, right, that legal would be involved in and that would have to look at. And again, you might have students all over the country, but now you're getting into the issue of, well, we're located in this state, and when we make our agreements, it's based on a contract in this state, so our laws would apply. And sometimes there's choice of law. So I think my answer is no, I don't really have a good answer for you. I have to punt people back to probably their own legal.
Well, actually, that's probably the best answer, because things will change from state to state, and actually can change even in jurisdictions potentially. But I think it's a good piece of advice that we do need to make sure we're talking to our attorneys, so we're dealing with our own specific situations.
Yeah, David, this is Scott. I think it does boil down to the type of debt as well. You have contract-based debts, promissory notes. You have non-contract debts at times based on the accrual of a tuition-related debt, that all are impacted on the types of fees that can be assessed against that, both in interest as well as penalty assessments for collection costs, things of that nature. So it really does come down to jurisdictional oversight based upon those types of factors.
Thanks, Scott. Michael, why don't you continue? We'll take some questions a little later.
Okay, great. I'm going to move quickly here because I think I'm getting nearer to the end of my time. And let's see from the slide here. I want to talk a little bit about the CFPB complaint portal and the issues that were identified. And again, these may not be your borrowers directly, but these are the issues that are coming up most for student loan borrowers. And these are the kind of things, again, and I'm not sure what any one of you, how you handle payments, or if you're looking to make changes, but these are the kind of processes, right? Because the result of your policy on payment processing clearly impacts your borrowers. Pay ahead issues, and these are the issues where if my payment is $100 and I pay $200 this month, does that mean that my $100 for this month is good and you just sort of sit on the other $100 and I'm paid ahead for next month, and then when my due date next month rolls around, you deposit it? Or would you deposit $200 today and I'd have another $100 to be paid down on my principal? And I think they're looking at that because people are concerned about that. And they're, in terms of when we look through some of the data, it's not only how are you handling it and what's best for the borrower, but it's also is it transparent and is it clear? There seems to be complaint issues that the borrowers are overpaying in some instances and they're not quite sure. When next month comes around, when they look, they don't see that they don't owe a payment. The system just still looks like they owe a payment because it isn't set up to reflect the pay ahead. And again, that may or may not be an issue for you, but it's one that the CFPB is looking at because they've got a lot of complaints. They're looking at obstacles, another large complaint category, obstacles for borrowers seeking to modify repayment terms during hardship. And I think that's the largest complaint category when we looked at the numbers. And again, is this just sour grapes? I can't afford to pay it back, and my creditor, right, my lender, won't work with me and take my $4 a month. I think that's one way to look at it. I'm not sure it's the best way. I think it would be a good idea for colleges and universities to take a look at what do we offer, right? I mean, from a private lender standpoint, you're able to do certain things and come up with your own initiatives. And I think it's time to look at this. And again, maybe it's sour grapes and you don't care about these borrowers, but I doubt that. I think you wouldn't be on a call like this if you didn't appreciate that not only does a regulator look at this, but there's a reason that this is one of the #1 complaint issues. It's because it's the reality of our society and our environment right now with the economy and where people are with lending and loans and jobs. Next big issue, payment processing issues for payments exceeding or less than the minimum due. And when you've got multiple loans, and some of this, if you're doing this sort of stuff intentionally, right, then you shouldn't be surprised if the government wants to visit you. I suspect that when it happens, it's probably just maybe it hasn't been thought out. And I think that's what the regulator is looking for folks to do, is start looking at this and saying, hey, look, if I've got 2 loans and they've got different interest rates, and I make one payment, if the borrower doesn't specify how that payment should be made, does the overpayment, and this is, again, this probably applies to each of you, if you get an overpayment, is the overpayment divided among the 2 loans equally? Is it divided pro rata based on the balance of those 2 loans? Or is the overpayment contributed to the loan with the higher interest rate? Right? And again, I'm not saying that it's got to be perfect, because sometimes there's a catch-22, right? There's competing interest, and I think we deal with it as collection agencies in different aspects. But you can also look at, well, this account's got a higher interest rate, but this is a debt that's about to charge off. Okay, right? Because if you're, in terms of different industries, but say on a credit card, it's about to charge off versus an account that has a higher interest rate. I mean, there's a balancing that you have to do there. And I don't know that the government needs or wants people to be perfect, but I think they want us to try. And I think they want you to try as well. And that means that if you're not looking at these types of issues, you should. Borrowers that send in less than the payment, they send in a dollar amount, they send in $150, but they've got 2 loans, and each of those loans has $100 due, let's say. Did you put $75 on both of them, and now he's got 2 late fees? I mean, and again, I don't have all the answers. I think it's something, an exercise that needs to be done to evaluate, how are we treating these folks, what's fair, what's not fair, and again, there's probably not a way to make it perfect, but the process, you should go through the process to figure out what can we do, and then from there, well, let's talk about expectations again, and let's make disclosures to students so they understand. Here's what we're going to do. Here's how we're going to deal with it. If you tell us how to allocate the payments, we will. If you don't, here's what we do. And that disclosure goes a long way to helping you when you're sort of in a pickle over, geez, neither of these is a great option, right? Okay, the timing of payment processing, when if you're getting payments, and obviously if there's deliberate activity to sit on payments so you can generate fees, I think we all get that. The government's going to come visit you. But again, processes need to be looked at. How long does this take? How long does it normally take? What channels do these payments come in from that impact payment processing? And not on the ERS side, but on the URS side, which is an affiliate of ERS, we bumped into this issue with some different clients in terms of if we receive a payment and we remit nightly to some clients, or what if it's weekly or monthly to smaller clients. We work real hard to make clear that you're posting the payment when we received it, or you're sitting on it for a month, because that might impact the interest, right, or fees or things like that. So, and again, doesn't have to be perfect, but the processes should be thought through. The other issues here, access to payment histories, really that's an issue that I think is easy enough to look at. People are complaining about it, and I don't know how you do that. If I can go online for each of these universities or colleges and see my payment history, or if I have to send a letter or I make a phone call, if you have all of those options available, that's great. If you have some of them, that's good. If you have none of them, well, you might be one of the complaints, I guess. Service or transferring chaos, I think, that I think you all understand servicers play a large role in student lending, and that's why the CFPB is getting ready to really, and they're already getting involved with these servicers, but to start supervising and examining because of the role they play. And on the borrower side, if the servicer changes, it creates a nightmare if they can't access the information. Okay, the next slide here really talks about the CFPB Ombudsman discussion. This is another document that's available on the website. And I'm not going to go through each of these other than really the last one I want to talk about because I think it's interesting because the director of the CFPB has really, and I think it's foreshadowing, likened the student loan marketplace to, pre-economy collapse based on mortgage lending, right? That we have this huge increase of student lending, and I think student loan debt is now second to everything other than mortgage debt. I think it's surpassed credit card debt. But it's telling that the regulator is looking at this situation and saying this is near crisis in terms of how student loan debt is ballooning and how it's being handled. And I don't know if it's just posturing to be able to move further along with their initiatives, but at a minimum it's foreshadowing that, hey, what they're thinking and they want to get more involved. And as an example, they're looking at some of the new mortgage rules under RESPA, which I won't bore you with mortgage stuff, but one of the ideas is that, should lenders be required to make an effort to talk to folks before they go in default? I mean, talk to them live on the phone. Should they be required to send a letter after a missed payment? That sort of thing. And if you that sounds good when you think about it. It sounds like a nice thing, but if you're involved in the operations side of your institution, I think you start thinking, well, if he's late, I call him, and then I send him a letter, and then he pays, and then he does it again and again and again. A lot of these things, really, you have to remember there's resource issues, and that's one thing I think the government has the benefit of, is they don't necessarily have to deal with the same issues that we do in allocating resources to satisfy some of these things. But that's just an example of an idea they had, almost the one above where they suggested requiring notice before and after of a change in servicer. Okay, I think the next slide talks about the Banking on Campus forum, and again, I think that's on the website, the material from that. And I talked about that, I think, before in my other example, so I don't want to spend too much time there. Ideally, I think some of these relationships can be win-win-win, right? If there's revenue and convenience for students and revenue for universities and these bank relationships, there can be access to your students that they wouldn't have otherwise or without any competition, but are we considering the impact on the students? Are they getting a better deal than they could get otherwise? Because presumably there's some leverage based on that uncontested access. And then transparency over those types of relationships. And again, if you're interested in that issue, it may or may not apply to you. There was that forum has actually got some good material in it that you can access on the website. And then my last slide, so I can leave Pat some time, and I apologize for going a bit long. Really, I think some best practices to move forward. You should be thinking about a CMS system if you're not already. If you've got one, I think that's great. It's time to refresh it. In all honesty, what we found when we started looking at this was we were reactive for years. We had policies and procedures that were created, and then we put them on the shelf. You create them when you need them, and you put them on the shelf, and that's not really a robust method to make sure that the right thing currently is happening. Take a look at that CFPB examination manual. Those modules in there are the blueprint so that your expectation of what the government wants you to do is consistent with, well, what they want you to do. I think this is a regulator that really you need to keep an eye on. They have their hot button issues, right? And one of them right now is student loans. It's very topical in the media. I just read I got an email thing that came today that talks about in Illinois that somebody's introducing some new legislation to have some new requirements about repayment options on student loans. So it's very topical in our society today, and this regulator is aware of that and interested in it. So I think it's worth staying on top of them in terms of their site. You can go and register, and they'll email you updates and bulletins as they apply to whatever industry you want, and I think that's worth doing so you can stay current on what they're looking at. And that last slide, again, I think I'm hopping back up on the soapbox, but I think what they're looking for is that we financial institutions and non-financial institutions that are making loans really to take a cultural change and not necessarily look at the bottom line as the only indicator. And again, in the college and university space, that's a little different than at a bank where there's, you think it's more bottom line oriented. But sometimes we make decisions, I think, because we have an operation or it's a business to run. And the government is really looking to start thinking about what's fair and what's fair to consumers as borrowers. And I think there's lots of examples that I don't have time to talk about, but I'll leave it there. And again, if there's more questions, I'm happy to help out, whether it's now or after the presentation.
Michael, thank you. There are two questions I want to put out to you real quickly. One is how do we distinguish the difference between laws and regulations that would apply to universities as first-party sectors versus the laws and regulations that would be applied to third parties? And the examples listed TCPA, FDCPA.
Okay, I think that's a great question and two good examples. So the FDCPA, right, the Fair Debt Collection Practices Act, specifically provides that it's applicable to third-party debt collectors. And it can be applicable to creditors or lenders if you want to think about it in that respect. I'll share with you, interestingly, that the CFPB is actually considering whether or not similar rules that are contained in the FDCPA should apply to first-party collectors. But I don't know that there's one-stop shopping to get your answer. Most of the laws themselves will tell you, right? The FDCPA is pretty clear in that law that the scope is third-party collection agencies, right? You're collecting for somebody else, and you got the debt after it was in default. The TCPA doesn't talk about, it doesn't exclude anybody in terms of who it may or may not cover. And I think TCPA is one of the biggest concerns we should all have out there from a liability standpoint. But within the law itself, it does not distinguish or exclude whether it's banks or collection agencies, or you see marketing companies sending out text are covered by it. So I don't have a good answer. I'm sure there's some resources, and if somebody's got specific questions, I'm happy to help. But typically, you're going to have to look at each of the laws to decide, hey, does this one apply to me? And again, if you tie this into your compliance management system on the front end, and it's got to happen at a high level, that's part of that risk assessment, right? What laws do apply to us? And it may be that you need some help. And I don't, I mean, I'm a lawyer, but it doesn't mean I'm always plugging lawyers. As a lawyer, I need help sometimes on laws because I'm not an expert in many areas. But that risk assessment, that's one of the important pieces on the front end at a high level to make sure you identify the ones that do apply to you. And of course, don't waste time if there's some that don't.
And I think, Denny, you probably agree on this also. It's important, even if it doesn't necessarily apply to a university, because of the business relationships we have with our third-party collectors, servicers, and other business partners, it's really important we're aware of the laws that are impacting them, because at some point we may be held liable, or at least need to know circumstances where they're being impacted.
Yeah, I think you're right, David. Ignorance is not an answer.
And especially when the CFPB is starting to think in terms of first parties as well as tying with the laws that traditionally have been to third parties, such as FDCPA, it's going to be that much more important. We'll
and I
more
would-
questions at the end of the discussions. I want to turn the program now over to Pat Woods, who's the Executive Director of Enrollment Services in the University Bursar at Southern Methodist University, to talk a little bit more about what's going on her campus, some of the changes, some of the things that are impacting the campus today. Pat?
Thank you, David. Just a quick weather update from wintry Dallas. It's now 34 degrees and dropping, so I'm happy that this webinar was today and not tomorrow. I just want to start today. What my piece on this webinar is mostly about the student rights and responsibilities agreement that we all need to have in place as universities. And in our research, we've come up with some interesting information. I'm going to start with a little history and background. Consumer protection laws began back in 1968 with the Consumer Protection Act, which was part of LBJ's Great Society agenda to eliminate poverty and social injustice. The CCPA was initially enacted to help with mortgage lenders to keep them from being able to hide fees and terms from the borrowers. But over time, there were many amendments and many acts that were added to this, looking at other financial types of transactions. Then in 2010, the Dodd-Frank Wall Street Reform and Consumer Protection Act was passed under the Obama administration, just what Michael has been talking about this entire time. And this created the Consumer Financial Protection Bureau, and it transferred all authority for the writing and enforcing of rules to this group. And the director has already stated that his primary concern, he has two top concerns. One is the privacy of information, debt collection information, and the other is the way collectors treat the borrowers that they're trying to collect from. And I think with increasing student loan default rates has come a growing interest and scrutiny into the educational lending process. It's very, very important today that we as colleges and universities make sure that we remain in compliance with educational lending regulations and debt collection practices, while also still doing what we are here to do, and that's collect the debts for the university. And it's somewhat just a little bit like what Denny said earlier, and David, that it is our business to know the laws that govern the folks that do business for us, because at the end of the day, when we're having to talk to our presidents or whomever, it's going to be us at the table. So we really need to understand what those laws are. So as we started to write our rights and responsibilities agreement, we tried to determine what were the important regulations that we should consider when creating this document. And one of the first things we thought about were the bankruptcy laws. In order to protect the assets of the university, you have to be able to convert accounts receivable balances into non-dischargeable student loans. And of course, you have to have the students accept that that's what you're going to do with their past due account. The second thing that we thought was important to consider was the Telephone Consumer Protection Act. We need to be certain that all of our students give us express consent to be able to call them on any phone number or that they provide for us, and that also all agents that act for the university be able to call them on those numbers as well. The Fair Debt Collection Practices Act, as they've just said, was really enacted to provide collectors with a list of rules that they had to follow to protect consumers or borrowers from being harassed or treated unfairly. And it does generally apply to third-party collectors, but again, it's something we really need to be aware of. The Fair Credit Reporting Act was enacted to regulate collection dissemination and the use of consumer information, including consumer credit information. In order to report a debt, it is critical that you have the correct information and that it be complete. If the debtor disputes that, you have a responsibility to respond to that dispute within 30 days. And you also have to inform consumers what negative actions or information could be passed along if in the coming 30 days or the past 30 days. So I'm sure most of us have in place the letters that we send saying that if we haven't received payment, that it will be forwarded to an agency and that it will reflect negatively on your credit report. So that's kind of what we used to decide how we needed to structure our Student Financial Rights and Responsibility Agreement. And now I'm just going to go through each topic of that agreement and talk about a little bit about what we said under each heading. So we can go to the next slide now. I'm going to read the statement. We didn't want this to be a totally negative thing for our students, and so we wanted to start it out with something a little positive, and I'm just going to read you what we've written. Southern Methodist University's mission is to be a leading private institution of higher learning that expands knowledge through research and teaching. It is the Office of the University Bursar's mission to provide quality service in achieving financial resolutions for students and their families. And so we have over the years tried to get this information out to students and families in every way we know how. But what we came up with was every semester our students have a personal information hold on our registration system. So every semester before they can enroll, they have to go in and check their addresses and phone numbers and make sure that those are all up to date, so in the event of an emergency we would be able to reach them. Well, we're also going to put a Student Financial Rights and Responsibilities Agreement hold so that every semester before they can enroll, they have to go on and they have to at least say that they've read this and agree to it. Now, we all know that that most of us don't read all those agreements that come across our desks, but there will be some students who read it, and we are forcing them to have this information in front of them, whether they read it or not. So I feel like this is a really huge step forward. The first section on ours is Student Financial Obligations and Tuition Repayment Agreement, and it's really just the student saying that they understand that their student account is their student account, and it really doesn't matter whether financial aid is supposed to cover part of it, a parent, an employer. It really doesn't matter. At the end of the day, that account's theirs, and they are 100% responsible for that. And they also agree that if they don't pay it, they understand that this is a binding agreement. When a student enrolls at the university, it creates a binding agreement, and that this agreement will be used for educational purposes and will constitute an educational loan, thereby making it non-dischargeable in bankruptcy. So that's our first section. The second, we talk about withdrawal. It's really important that students understand the withdrawal policy, because so many times we have students that feel like they have to withdraw for financial reasons. And if they have not really carefully reviewed the withdrawal policy, they're not aware that their financial situation could be worse after they withdraw than it is before. So we are going to say to them in this, please make yourself aware of what those policies are, what those dates are. And we also are going to ask that they not process their withdrawal until they talk to their financial aid counselor, if they have one, or to the University Bursar's office, so that they can get a little bit of advice before they move forward with that. Our next section is failure to pay. And this is the student saying that they understand that we generate bills every semester, that we send them to their email account. The system that SMU uses, we have an authorized payer as well, and if they've created that on our system, then we also send that authorized payer a bill or a notification that their bill is out there ready to read. We have monthly payment plans that they are more than welcome to do. The one thing they have to know is the payment plan has to be resolved or created prior to the payment due date, or they will still receive late fees. We refer them to our website for other payment methods, and at this point we do inform them of what our late payment fees are. At SMU, our late payment fees are from $250 to $999.99. That fee is $50. From $1,000 to $5,000, it's $150, and from $5,000 up, it's 3% of the outstanding balance. So those fees are pretty significant, and we want them to know ahead of time so they're making informed choices. If they choose not to pay on the payment due date, they need to know what the consequences of their actions really are. They also agree in this section that they understand if they don't pay, they'll get a late on the payment due date, they'll receive a late payment fee. Then we don't assess past due fees. For example, in fall, when your payment's due in August, we don't assess a past due fee in August or September. We give them that time to get their financial aid straight and so forth. But beginning the end of October, if they have not paid their account in full, they're assessed a past due fee at 1.5% of their outstanding balance, and that will continue until it's paid. We also inform them that they will not be allowed to enroll for a future term. They may not get a transcript, a diploma, that all of their rights may be withdrawn when they don't make the payment on their account. Our next section is collections for non-payment. And in this, the student is agreeing that they understand that SMU can pursue any rights or remedies that are available by law to collect their account. So it's basically just saying, I understand that if I don't pay this, it will be turned over to an agency. Collection fees will be assessed, and I will be held responsible for those, up to 50% of the outstanding balance. So we just want to tell them every opportunity we have, this is what's going to happen. We want you to be informed, and we don't want you to have to pay these fees. We want you to just pay your bill, and that's what we're trying to do here. The next section is the collection activity involving cell phone numbers and email addresses. It's just kind of more of what we've been talking about. It's an authorization authorizing SMU to use any number that they have provided to us and to let our agents use any number that they have provided to us to contact them. It states in there that there is a possibility they could have provided a phone number for us that's not secure, that someone else might hear. We are very careful about not giving specific information on a cell phone or any phone for that matter, but that there could be someone who could hear that we left a message that they needed to call the office of the university bursar, and so everyone knows generally that means that they owe money. And so we just want them to agree to the fact that they're not going to hold us liable for that fact because they have given us that number. We also state in here that we have the right to contact them at any email address they might have given. During the time a student is at SMU, their official email address is their SMU email address. But of course, once they're gone, any email that we could find and we want to have the ability to use. So that's kind of what that is talking about. The next one is 1098T reporting. And this is new, and we just decided that it would make sense to add it. Not that they have to really, we just want this as informational. I'm sure most of you at universities received the IRS letter this year, and so we've all been scrambling to put in place what we need to do in order to be sure we have correct Social Security numbers. What we wanted to tell our students, was there are certain educational credits education credits that they can claim, and that we have to provide this information to the IRS, and their obligation to us is to provide their Social Security number to us. If they are eligible for a Social Security number, it is their responsibility to get one and to provide it. And if they don't, we notify them in this document that we will notify the IRS that we attempted to get a Social Security number from them and they did not respond, and then they may be held accountable for a fine by the IRS. Our next section is governing laws in place of disputes. We have for a long time felt it was really important that we be able to take care of all of our collection activities in the state of Texas with the laws, the collection laws that govern the state of Texas. And so in this section, we're just basically saying that I agree that this is how collection will be handled based on the laws of the state of Texas. They also say they agree that they will not commence any legal action outside the state of Texas. And so that just makes things more simple for all of us. Now we know that everybody can go and do what they want to do, but we will have this agreement that they have signed, and we have it date stamped, time and date stamped, to show that they did agree to this. We also have a section on amendments or changes of terms, and it's because things always change. So we are hopeful that the changes will, that the way we'll notify our students of the changes every semester, they'll have to go out and review this document again. If there are any changes, they will be noted in that document. If for some reason there happened to be a major change that we felt like they needed to have ahead of time, we would do something via email for our students. And the last part that we have on here is the billing rights summary. And that's just telling our students what we consider to be their responsibilities. We just want one last time to kind of say to them, this is what you're responsible for. Registering for classes and knowing the classes that you're enrolled in. Reviewing your bill for accuracy and addressing any discrepancies. Following the correct procedures to withdraw from classes. Let's see. Understanding available payment options and methods. Completing any applicable financial assistance requirements so that your funds are disbursed on time, and paying any and all financial obligations by the due date. That's what our document is going to consist of, and this has been a work in progress for a very long time. I want to touch a little bit on the next slide, is a little bit about possible barriers. There can be barriers because of technology. Sometimes your existing system just doesn't have the capability to keep up with this, or that others, the administration part kind of fits in with the technology a little bit, in that interdepartmental relations, you have to get everybody to really understand that what you're doing is not only, it isn't really about protecting the bursar's office, it's about protecting the students and letting them be aware of what they can do ahead of time to keep from having to get out of a big mess later on. And so for us, for example, it's the registrar system that we're going to put this hold on and not allow them to enroll. So we had to work with them, and I had to really work with the registrar so they would understand how important this was for our students. It also has to, of course, go through your legal department for approval and implementation, and that sometimes can be really difficult. I think that it's wonderful for if we have contacts for our attorneys. I think earlier the question was stated about, with Michael, about should the attorney be the one that takes care of everything. Well, the attorney really can't take care of everything. You have to do your homework, and you have to provide for them what you believe is, for example, this document and what we need to have on file. Now, if they have questions, it's also great if you can have a contact for them, someone who isn't, excuse me, someone who is an expert in this type of law. For example, the attorney that works with my area is also over the athletic department and student life. And so there's no way that they can be an expert in every area. So sometimes if we just go prepared and say, this is an attorney and here's his number and you can give him a call and he'll help clarify some of this, it just is really helpful for you and for your attorney. So that's what I had to say this afternoon. I appreciate your time and attention, and thank you for joining us today.
Pat, thank you. We have a couple of questions for you. Let me just pull them back here. I'm trying to put these together so this will be a series. There's been a lot of talk so far about student loans, but what about student AR? And I think you focused on that with your responsibility statement. But should AR be considered a loan in this regard because we're extending credit? Or is the CFPB going to look at AR differently than student loans? Michael, you may want to chime in on that as well.
I'm sorry, can you kind of say that again? I caught the tail end of that. I apologize.
Okay. I guess we talked about student loans, but student accounts, should they be considered as student loans when we have an agreement because schools are extending credit? And would the CFPB possibly look at these accounts differently than student loans?
I think that's a great question. I don't know that the answer is clear. I know that they're looking at the banking on campus relationships, and those relationships are clearly not what I think we would think of as student loans and private lending loans. And in fact, you know, there's not even a lender relationship. It's how the bank, how the university dealt with a bank as a vendor. So, you know, there's this vague, I don't want to say vague, a very general concept of, you know, unfair practices, you know, deceptive acts and abusive practices. And the CFPB has broad regulatory jurisdiction, and that's the scary part when you look at this regulator, is that it doesn't necessarily have to be spelled out in a law. It can be that if they don't like it, if they've got jurisdiction over you so that they can look at what you're doing or field complaints about what you're doing, they can come in and address it. And if they deem that it's an unfair or abusive practice, they can address it. And I think that's where some of these other issues come in. So I think you need to be concerned about it. And I wanted to double back to when somebody asked a question about some of these other laws that may not apply. And Scott, you're not going to want to hear this one, or I mean, you know it, but you may not want to hear it on the call here. But there's probably a host of laws that apply to a collection agency, such as ERS, that don't necessarily apply directly to a college or university. But you've got a responsibility, again, to your borrowers, right, in our new era, to make sure they're treated fairly. So when you send accounts over to Scott and Steve and ERS to work for you, you've got a responsibility for how they're treating your borrowers and making sure that they're following the rules. So while the FDCPA may not apply to you, from a vendor management standpoint, right, that's what I'm getting at. There's a responsibility now, even in the student lending marketplace on the collection side, of knowing what your vendors are doing and are they doing it well or fairly, or, you know, do you just have your head buried in the sand waiting for a check once in a while? It's probably going to create some issues unless you're using a great agency like ERS.
David, just a comment from me on that question. In our research, what we found was that if the student left and did not pay their account, it became an extension of credit, which was a loan that we had made to the student. And that's how we came about putting this into our agreement.
Okay, Pat, just a follow-up question for you also. When students accept the terms online, do you have the ability to track the date, the time, and identify the specific student when that agreement is accepted?
Yes, we will. We will be able to pull a report at any time that will show their SMU ID number and the date and time stamp.
And I believe most ERP systems have that capability as well.
I would assume so, yes.
And we've had a couple requests, Pat, and we'll get back to people after after today, as far as we may be able to get access to the document that you're using. We've had a couple requests for language.
Okay, that would be great. I would be happy to.
Okay, and then one last question, Pat, and then I want to turn this back to Scott for a minute. The slides that were labeled rates and responsibilities for students, are the students required to accept all of those terms at the point of registration?
Yes, they are.
So it's not pick and choose. It's everything.
No, it is not. They have to accept them all. That's the Student Financial Obligation Agreement. Now, the one piece that they can go back and change that they have to provide to us in writing is the authority to use their cell phone. If they decide that they don't want us to contact them by any method, they can, in writing, inform us of that, and we will not contact them, nor will we let an agency contact them at that number on our behalf.
And to try and put that in some perspective, at Temple University's process for financial responsibility, with over 42,000 students agreeing over a 10-month period, there's only been one request to have the cell phone removed. So it's
exactly.
Not
to be honest, I don't know if enough of them read it to know that it's even in there.
Yeah, but you do have to have that in place to be in compliance with the Telephone Consumer Protection Act. So that's just one point we wanted to bring out. Pat, thank you for your information. It's been excellent. I'd like to turn this back over to Scott to talk a little bit about how ERS is applying compliance changes that are taking place to the company. Scott?
Sure. Thank you, David. I appreciate it. And I also, just on behalf of ERS, want to thank both Pat and Mike for their presentations. Very informative this afternoon. In the interest of time, I'll be relatively brief, but I wanted to provide a case study of some of the impact that the CFPB audit guide in what has been referred to by both Pat and Mike as the Unfair and Deceptive Acts Policies and Procedures litmus that has been put forward. And what this has resulted in for ERS is the creation of a more formalized approach to compliance structure that has clear and distinct divisions of responsibility. And it's really come in 2 points. One, from an increased investment in human capital that's dedicated to compliance and quality assurance. And then secondly, in a more structural format. So with respect to that investment in human capital, some of the things that has occurred within our organization is the development of a more mature quality assurance process and a team of individuals that are dedicated as testers to those types of things that monitor sampling of activities that impact the consumer directly. So a very specific example would be collection calls that are generated by our collection staff in the act of recovering the outstanding debt. Every collector has to go through a series of monitors on a pass-fail basis through the course of the month, looking at everything from the quality or approach of that call to the regulatory and legal dynamics that are constructed within the context of that call. This team also monitors the disclosures that are given and process-oriented activities, the flow even on the Federal Perkins program of information as it relates to loan consolidation, things of that nature. And the dynamic impact that has is we've increased the staffing in that particular area at a ratio of 1 quality assurance representative per every 25 collectors. So it shows the extent of activity that really is pushed out from that particular team. Separate and distinct from that group is our corporate compliance team. And what they really do is they review the results of this type of testing and manage and analyze what those results mean and ensure that there has been education and remediation that is a direct result and holds operations accountable for the actual performance of those testing results. They also manage and analyze complaint logs, both those that are public-facing, such as the CFPB complaint portal, as well as our own internal process of receiving complaints, down to the point of any verbal complaint that is issued during the course of the collection process is logged and monitored. And those results are analyzed and assessed for root cause, and trying to determine if it is a breakdown in communication or if we have a more global issue based upon a policy or a practice. That is that particular team. We also, as a result of this process, evolved an ombudsman role that is out there and separate and distinct from the operation reporting structure that is designed to handle borrower-related issues and resolve those issues to the satisfaction of all parties. And finally, to help facilitate some of the structural change that has occurred, we have deployed a group of technical writers that are designed, were in place to assist with the effective policy and procedural documentation required to manage the organization from a compliance standpoint. So on the structural side, that really feeds into something that Mike referred to earlier, which is the formalization of the compliance management system, or CMS. We are not unlike many organizations where we had a very compliance-centric philosophy, but not necessarily the overall structure that would document the overarching policies and things of that nature in a logical stream. So we have gone through the process of creating this compliance management system through the assistance of this team of technical writers and under the guidance of our Director of Compliance Management. We also created an Executive Compliance Committee, and that committee is responsible for a subset of activities. First and foremost, the approval process for all policies that are developed and entered into the CMS system. The Executive Compliance Committee also reviews the trend analysis that comes from the Corporate Compliance Group and makes organizational decisions as a result of that type of data, the root cause analysis, and whatever structural changes may need to occur. It is also the responsibility of that group to review all the underlying regulations, so FDCPA, the Fair Credit Reporting Act, Privacy Act, Reg E, Reg Z, the multitude of state laws and other areas that impact the consumer, and assess those for what impact they have to our organization and what client practices or expectations from our clients have that impact our ability to perform and collect or perform collection-related functions. So a good example of something like that might be the Fair Credit Reporting Act, where we have clients that have an expectation coming in that we would report a debt to a credit bureau while enterprise is servicing that particular account. But under the auspices of the FCRA and what the CFPB expectation is of the agency, is that there has to be explicit documentation of the status of that debt and the underlying activity that affects that status, and not just from the point in time that the agency has received that debt. So what this has really done is forced us as an organization to go back and review those relationships and understand whether or not we actually have that meaningful trail of documentation in order to effectively report based upon the expectations of that client. And another particular area that Pat mentioned, and I really enjoy hearing this, is the consent issue surrounding TCPA, because that does have an impact on how we communicate with your constituents once that account is placed with us. In having consent coming and being conveyed upon us certainly makes that path significantly easier. Finally, with the Executive Compliance Committee, it is the expectation of that Executive Compliance Committee that it reports directly to the General Counsel and the board of the organization as it relates to all of these types of activities. And the sum of this is to really just demonstrate and solidify the company's commitment to compliance, both by practice and through the leadership of the organization. So, these are just some of the initiatives on a case study basis that have really evolved as a result of this process, and frankly has helped to strengthen the organization, but has changed the dynamics of how we staff, how we work, and how we interact with our clients. So those are basically my comments as it relates to the case study. And David and Denny, I would turn it back over to you.
Thank you, Scott. We've got time for maybe one or two more questions. And again, many of you have asked to see copies of the SMU Rights and Responsibilities form. Pat, that'll be it. So that's something we can distribute after the webinar next couple days?
Absolutely, yes.
Okay, I think we've taken most of the questions off the table then. But you've been well received. I think a couple other questions we had. One goes back, and Carol, you raised about questions about double payments and what's the correct way for posting these payments. Michael, that may be something we want to have you answer offline, and we can share that with the group unless there's a simple answer.
I don't think there's a simple answer. I think you're going to have to look at it on a case-by-case basis, decide how you want to, there's a, if you want to call it a workflow of one payment, multiple accounts. If both accounts have the same interest rate, there's a couple factors I think you'd look at, and then try to make a good decision. It's not always going to be perfect, right?
Would you suggest that in today's climate, we really want to try and be borrower favorable, as you mentioned about not creating excessive late fees being posted, or maybe actually going back to a borrower and saying, how did you really want this applied?
I think the answer to both of those is yes. On the first one, I think we're well past, doing things that are generating fees is going to create problems. I think the regulator is going beyond that, saying, hey, aside from what may create fees, what's best for the consumer generally, and it's not always just a money issue. So I think there's actually more thought that might have to go into it. And again, I don't want to make it's not an intimidating process. It's just a process that you go through, I think, once, and you think about all the possibilities, and you map out a plan to say, here's how we're going to deal with it. And you're not always going to, you can't take care of everybody and make everything okay, but you should at least think about the impact of if we do it this way versus the other way. The other one, I'm not sure how realistic it is, certainly from a resource standpoint, to contact borrowers and say, hey, we got this, what do you want us to do? Certainly if you can do that, that's the best way to do it. If you can get direction from the borrower, then you're on solid ground.
Great. Michael, thank you. I'm going to turn this back over to Denny and Steve to close out. I want to thank everybody again for their participation. And any other questions that we might have, again, you'll have some information about where to direct those questions. Denny, the floor is yours, my friend.
Thanks, David. Well, Steve, I think we are winding up with another great webinar, the last of our series for this year. What do you think?
Yeah, I think it was outstanding, and I again want to thank Pat, Michael, and Scott. I think that the presentation was very well thought out and delivered very effectively. So again, thank you for putting this together for us today. I do want to mention a couple things. As I mentioned before, the PowerPoint is available on the website right now, and many of the documents that were mentioned by the presenters today. Tomorrow, probably in the afternoon, you'll have the actual PowerPoint with the audio to go along with it. That'll be available for a download. I believe we'll be sending out an email notifying you exactly when that's available tomorrow, so look for that in your email box. Lastly, there's a post-web survey that's available right after this webinar concludes. Again, it's much appreciated that you take the time to complete that. It does give us ideas for presentations, which we'll be rolling out for next year. So again, if you could take a couple minutes to complete the survey, I would greatly appreciate it. That's all I have. So again, thank you everyone that attended today. We had a great turnout today. Enjoy the rest of the day. Thank you.